Good morning, everyone. My name is Atif. I'm joined today by Philip May, and today we will be discussing a very delicate subject, Canadians investing in the US real estate. And I'm pretty sure you guys are here because you are thinking about it, about this topic. And I certainly was thinking about this topic when I was shoveling the snow last night. Having said that, one of the things that you have to be careful about is that when you are investing in US, you can go to a US tax lawyer and get a great advice. But if that advice does not factor in the Canadian tax rules, it can produce terrible tax results for you. That's why you have to think about both sides of the border when it comes to investing in the US real estate. Today, I'll be talking about the Canadian tax matters as they relate to this topic, and Philip May will be talking about the US tax matters. Before Philip takes us to this 1-hour journey, some housekeeping matters. We encourage you to participate in this presentation, webinar. You can share your questions over the chat with us, and we will try to answer as many as possible. And we also encourage you to fill out a survey at the end of the presentation in which we want you to give us feedback about our presentation and suggest new topics that you would like us to discuss. And if you will notice, there are 2 barcodes, one on my right side and one on my left side. These barcodes can help you, if you scan with your camera, phone camera, can help you take you to our YouTube channel as well as Andersen's website. On that note, I ask Philip to take it away.
So here is our agenda for today. The first thing, we are going to go over some of the key tax factors on helping us on evaluating all the different ownership alternatives. And then the second topic, we will actually go through some of the more common ownership alternative that is available for Canadian owners. The next one, we are going to talk about just have a scenario about a gain on a US tax real property. So you could see a pretty kind of a nice summary of all the tax for different alternative. And then you could see a clear winner out of all those ones. And then the next few topics, we're going to talk about the US withholding tax, either on the capital gain on real property or rental incomes. And then we are going to cover some of the Canadian tax consideration and the US estate tax. So first off, we are going to cover the key tax factors. So what are the factors we would consider when we are trying to determine what is the best ownership alternative for Canadian investor in US real property? So the first one that we have identified is the most important in our mind, that is the US long-term capital gain tax rate. For US tax purpose, any gain that is holding the property for longer than 12 months, it qualifies for something called the long-term capital gain. The tax rate on it is 20% maximum, plus any state tax that is applicable. This preferential tax rate is only available for individuals, either through direct ownership or through some sort of partnership or any flow-through entities. What it means is the income from those entity would flow directly to the individual owners. One of the key concepts to bring out here is the difference or the distinguishment between capital gain versus business income. So you could think about it as if you're only buying the real property as an investor, you're not in the active business of developing real estate. Likely the gain of any disposition of US real property is considered as a capital gain instead of business income. In the case that the gain, you are actively buying land, building buildings, developing the building and then sell it at a large quantity, the gain would likely be a business income instead of capital gain. Then the individual shareholder would not qualify for the long-term capital gain treatment because the business profit is considered as business income. It's just taxed regularly. So this is the key kind of income tax consideration that we have figured out. The next one is tax deferral. So this concept should be, a lot of our audience should be familiar with it, is that a corporation typically pays a lower tax comparing to an individual does. So if we are able to have the income being subject to taxation in the corporate first, and then later pay out the after-tax earning to the individual, you achieve certain level of tax deferral. Usually the benefit is larger whenever the gap between personal tax and corporate tax is larger. In the setting of US real estate, it's only available for a corporation and only available for certain type of income, mostly active business income, because Canada have all kind of different tax regime to try to close the possibility of tax deferral by charging either refundable tax or the FAPI inclusions. So the next factors we have identified is the double tax risk. So as Atif have mentioned, whenever you're dealing with a structure in both sides of the border, you have potentially different treatment for different items. So some of the rule that could potentially apply is if you have a foreign entity that is controlled by Canadian, some of the income could potentially be subject to foreign accrual property income. Essentially, the income would be included on the shareholder's tax return on an accrual basis, even before it pays out. So in the calculation of FAPI income, the income should be calculated based on the Canadian tax principle. So in the case of a US real property, when the US tax base is based on the US tax principle and then the Canadian is on Canadian tax principle, there are certain items that could potentially is a mismatch. For example, if you have depreciation in the US, in Canada, they don't have the exact same thing. They call it capital cost allowance. So different expense could be claimed, and then sometimes foreign exchange could play in factor, resulting that the capital gain on both sides of the border doesn't match perfectly. So it could create some double tax risk here. The other common issue that we see is installment sales. So for US tax purpose, the taxpayer recognize the gain based on the proceed they receive in that particular tax year. So in the case that they get into an agreement for installment sale and receive the proceed for 10 years, they would recognize their gain over the 10-year period. Versus in Canada, they have something similar, but not exactly the same, called capital gain reserve, that have a maximum 5-year recognition period. So as you can imagine, that when Canada recognize all the gains in 5 years, while US tax recognize over 10 years, then you could have some potential mismatch. So this is the first three key factors. We have two more, that is the US estate tax exposures. So for those who doesn't know, US estate tax is just a tax applied against the estate, depending on your status. For US citizen or domicile, it would be worldwide estate, the fair market value of it. In the case of non-US citizen or domicile, like most of you that are just Canadian, doesn't have any status or domicile in the US, it would be only applicable for US cited asset. So US cited assets includes both US real and tangible property and US security. So it would actually impact some of our determination for the ownership alternative for future slides. The last one is a requirement for the owner to file a US tax return. There was some certain preference by the investor that they don't want to disclose the information to the IRS. For some of the structure, unfortunately, they would have to. So if the investor really care about this implication, there was some other structure for it. So with all the key tax factors that we have gone through, then we have come up with 5 common use ownership alternative. So we are going to go over all of them, outline the pros and cons for each one of them, and then at the end of this, all the alternative, we are going to summarize the income tax using some examples so you could see a more quantitative demonstration on which structure is best. So with that, I'm going to pass on to Atif to talk about some of the ownership alternative.
So we will talk about first personally owned. And as it says in the pros that we have to be aware of the US long-term capital gain tax rate. So refer back to the comment Philip made. One of the key factor was that in some conditions, you can qualify for long-term capital gain tax rate in the US, which maximum, I believe, is 20%. And as Philip was saying, it applies, is available in some situations. And some of those one of those situations is when you hold the property personally. So if you hold the property on your name, the US real estate property, then when you sell it, and if certain conditions are met, then you qualify for long-term capital gain tax rate. So that's a good thing. And the second good thing about the structure is simplicity. It keeps things simple. Property's on your name, you buy the property, and you go from there. The cons is unlimited liability. So if there is a lawsuit with respect to the US real estate investment property, then you are not only liable, your personal assets are also at risk, not just the US real estate property. So let me say this again. Your personal assets in Canada are also at risk if there is a lawsuit, if you hold the US real estate investment property in the US. So if something goes sideways, this is pretty big disadvantage for holding the property personally. There is no tax deferral. The income is reported on your personal tax return every year. And there is US withholding tax on rental and sales as well. You are also subjected to US estate tax. And that was one of the other key factors that Philip identified in his presentation, that the US estate tax would apply if you hold the property personally. So God forbid, if you pass away, then that property, if it is a situs property, the real property, it is subjected to the US estate tax. And you will also be required to file the US tax return. And the second alternative is to hold the US real estate through Canadian corporation. Now, the biggest pro, as in contrast to personally owned, is limited liability. So if you have a Canadian corporation and the US real estate investment property is on the name of the Canadian corporation, and something goes sideways, there's a lawsuit, then only your US real estate investment property is at risk, not your personal assets in Canada. So that's a big pro to think about. And if you're earning active business income, again, that could be a little bit complicated, but there could be a deferral available in that scenario. And no US estate tax applies if you pass away. And if you have a US real estate property that is held by your Canadian corporation, there is no US estate tax. Again, in contrast to the personally owned, you will be subjected, in the case of personally owned, you will be subjected to the US estate tax. Now, the disadvantages is long-term capital gain tax rate is not available, and which was available in the case of personal. So that is a bad thing. You will not be able to claim maximum capital gain tax rate of 20%. You will be subjected to a higher rate, relatively speaking. There is also a double tax risk. Again, Philip alluded to it, that if you have a FAPI income, which we will talk about later, I think Philip already discussed it briefly. But for the purposes of this slide, if you have a property income in a foreign country, in this case, US, you have to report it on accrual basis in Canada. So even if the income has not come back into Canada, you have to report it on the Canadian tax return. And if that happens, you have to Canadianize that income. You have to use the Canadian rules to determine what the FAPI should be. And one of the examples Philip gave was that there's a concept of depreciation. We use depreciation in the US, but in Canada, tax depreciation is different. So we will have to use the Canadian tax depreciation. We will have to look at the Canadian deductions and add backs under the Canadian tax rules to figure out how much is the FAPI that should be subject to tax in Canada. And that could create some double tax risk. A little bit more complexity in tax compliance compared to when you hold the property personally. You will have to file the Canadian tax return for the Canadian corporation as well. And the third alternative So the first was personally owned, the second was Canadian corporation, and the third alternative is Canadian limited partnership. Again, going back to the key factors, I keep referring to it to reinforce this point that if you individual partner or a flow-through entity holds the U.S. real estate property, you are the long-term capital gain tax rate, which is a good thing, is available to partnerships as well. So that's a good thing. Partnership is a flow-through, so the long-term capital gain tax rate is available. There is a tax-efficient structure because the income flows through to the individual, and the individual reports the income. But the partnership will also have to file the Canadian tax return, which we have mentioned in the cons. Limited liability, so you will have to set up a structure to make it so that there's a limited liability, and you will need a general partner for that, which is typically a corporate entity. So you will have a general partner, limited partner, and there is a partnership, and the main liability outside. So the limited partner will only be liable for the investment is made inside the partnership, and the general partner will be limited, will have higher tax liability. And for the U.S. estate tax, I will let Philip take us through that.
Okay, yeah, so probably a little bit of expanded discussion about the limited liability. As you can see that for the first three alternatives, we keep mentioning about either unlimited liability or limited. So I think there was no clear cut that whether you have to have it. It's just good to have it. A lot of time, depending on how risky the business is, the limited liability could be an appealing option, but also there was other method to get some assurance, right? You could potentially get insurance to cover the potential damage or the other things. As Atif mentioned, if we are looking into setting up a Canadian limited partnership, the individual partner would be the limited partner of the partnership, while another corporate entity would assume the general partner, which has unlimited liability. Since due to the unlimited liability, we would want the corporate entity, the general partner in this case, to have no asset. So other than the partnership interest. So in the case of a lawsuit, that's the only thing they could come up with. So let's move on to the U.S. estate tax comments. So we have discussed it before that U.S. security or U.S. titles asset would be subject to U.S. estate tax. So, and also a limited partnership is a flow-through entity. So it's questionable whether the individual partner is considered owning a portion of the U.S. real estate or not. So it may, or from the U.S. estate tax purpose, you might look at it as, is it really the individual owning some Canadian limited partnership interest? So it's questionable. However, in the U.S., they do allow a foreign entity to make an election, commonly referred as check the box. So the check the box election essentially is an election available for the taxpayer to change the classification of certain entity. Since a limited partnership is really uncertain for U.S. estate tax, there was kind of opinion going either way. We typically recommend our taxpayer, if they do holding a limited partnership, they make the check the election when they pass away for the limited partnership to be treated as a corporate entity. So some may question, how do you even make an election when you basically die? So it would be up to the executor of the estate. They could make a backdated election within 75 days. So as long as the taxpayer died and the executor is aware of this scenario, they should initiate the check the box election right before the day of death. So to be treated as a corporation, so we would reach a higher certainty of avoiding the U.S. estate tax. So that's just the pros or the flexibility that is provided for a limited partnership. So we have mentioned a lot about the pros for limited partnership. It does come with some of the drawbacks as well. Atif already mentioned one of them is for a limited partnership, you need to have more than one parties to be a partnership. You couldn't be a partner by yourself. So you need someone else to acting as the general partner. And due to the limited liability or unlimited liability for the general partner, we would typically want a corporate entity that comes with limited liability to begin with. So you would have to set up like two entity at the same time. The other coin is the partner, because getting a flow through income from the partnership, the partner have to file US tax return on an annual basis, assuming there was income. This implication can be avoided with the check the box election as well. Once the partnership is elected to be a corporation, it's essentially the same as if the partnership is being a Canadian corporation. So the corporation pay tax, and then the partner or the shareholder in this case would only report income when they receive a distribution from the entity. Due to the two entity that is required for the structure, there was a higher formation and a higher tax compliant cost annually. So this is a more complicated structure to set up to achieve all those advantages. So with that in mind, we are going to move on to next alternative that is really well recommended by a lot of US practitioners, either by lawyer, US accountant. The first thing they think of is something called a US limited liability company, or commonly referred as LLC. As the name suggested, an owner of an LLC has limited liability. Some of the other feature that is not so well known is the LLC could be disregarded if it only has one owner. So disregarded means for US tax purposes, essentially is nothing. So imagine that our taxpayer form an LLC and being the sole shareholder, and then the LLC buys another property. In the lens of a US tax purpose, is considered as the individual buys the property directly. So all the income, expense flow directly to the individual owner of the LLC. So by doing so, the owner kind of achieved the US long-term capital gain tax rate, which is preferential, as we have kept emphasizing. So those are great coins. You just set up the structure once, and then you achieve the best tax result without doing much of the compliance costs. However, the LLC works best when you're only dealing with a domestic US shareholders without any international component to it. Our audience today, most of you are likely have some sort of Canadian background, or either living in Canada or having a Canadian corporation. A lot of those pros is quickly got outweighed by the drawbacks. So the key thing here right now is just the double tax risk. So this one is slightly different than the previous one that we have discussed. I'm going to let Atif to give us a little bit more details on what's the specific double tax risk applicable to an LLC.
Thank you, Philip. So in Canada, LLC is treated as a corporation. So as Philip was saying, that it could be a disregarded entity, it could be a flow-through entity, or it could be elected as a even corporation in US. But in Canada, generally, it is regarded as a corporation. And that means that there could be double taxation. Now, bear with me here. I'm going to give you couple of examples. So we talked about a capital gain tax rate. In the US, one of the key factors that Philip mentioned was installment sales. So if you sell a property in the US, the capital gain is spread out over a longer number of years than it is in Canada. In Canada, if you meet certain conditions, you take a capital gain reserve for 5 years. In US, I believe, correct me if I'm wrong, Philip, that you'd only pay the capital gain tax when the proceeds are received.
Correct. So you basically calculate a gain inclusion depending on the percentage of proceed you receive. So if, say, you're going to receive 10% of the proceed every year for the next 10 years, then 10% of the gain is taxable.
Thank you. Exactly. So what that means is that you have included capital gain on your Canadian tax return, but on the US, you have not paid the tax on it yet, on the capital gain. You will pay it in the later years. So there is a mismatch. And the way the Canadian tax rules are worded, you cannot claim the foreign tax credit unless you have paid the tax in the US in this case. And if that happens, then you might end up paying double taxation on the capital gain that you earn in the US in a US LLC structure. So that's one. And the second part is that since LLC could be a flow-through entity in the US, so what that means is that for Canadian tax purposes, you do not recognize the income because for Canada, LLC is a corporation. You do not recognize the income until the income is distributed to the shareholder. And that distribution is regarded as dividend or treated as dividend. So what that again means is that you have paid the US tax, but you will pay the Canadian tax when the distribution is made. Again, the mismatch. The foreign tax credit paid in the US was in different years. The tax paid in the US was in different years. And in Canada, you cannot recognize it until it is paid. Again, a mismatch can result into terrible tax results. And that's what we were trying to say in the beginning, that if you go to a US tax lawyer and talk about LLC, it's a wonderful entity to have if you are a US taxpayer under certain situations. But unless you factor in the Canadian fact pattern, it can result into disastrous consequences for the Canadian taxpayer, and which can mean double taxation. So that's what you have to be extremely careful about. And that's what we mean when we emphasize the double taxation risk. And I will let Philip talk about the US estate tax.
Thank you, Atif. And also in the later slide, we actually have an example of all the taxation for different structure. So you could actually see how bad the tax result would be for LLC. So for US estate tax, as discussed before, any US security is considered as US citus asset. Interest in a US LLC is also a US citus asset, so the owner would be subject to US estate tax. The next point is the owner would have to file US tax return, again, because LLC is mostly a flow-through entity unless you check the box and treat it as a corporation. So whenever the income flow through directly to the individual owner, the owner have to file US tax returns. The last point is not so well known. It's really complicated in terms of tax terms. Is between Canada and US, we have a tax treaty. Mostly for the whole purpose of it is try to eliminate double taxations. Unfortunately, because of the nature of LLC, that is somewhat a hybrid entity, and the different treatment between Canada and US, a lot of time an LLC could not have access to the tax treaty. So what it means is the tax treaty doesn't apply to an LLC. So it's really bad. That's why some of the double tax was way bigger than the other structure. Is the treaty is not protecting it again. So with that in mind, we're going to move on to another common structure that is a US C corporation. A US C corporation is just a similar concept as a regular Canadian corporation. It's just a separate legal entity, separate tax entity, because in this case, you have a domestic or US domestic entity that is going to pay the tax. There was no requirement for US withholding tax on either rental income or sales income. The C corporation itself just paid the income tax. And then whenever it distributed out the after-tax earning to the individual shareholder, then either withholding tax would be applied or a branch profit tax could potentially apply as well. On the other hand, because this is a corporation, it does provide limited liability protections. Some of the cons about a C corporation is about double taxation. There was the timing mismatch due to the FAPI rules. There was the different items. So you can see that we keep emphasizing the double tax is really kind of an important factor that would impact our like structure decisions. The next one is there was no tax deferral in Canada. As we have discussed earlier, most of the time when we receive income related to real property, it's mostly passive. It's the requirement for getting a active business in either rental property or business development is rather tough, and it's not usually applicable to most taxpayers. So whenever there was the passive income, there was really no tax deferrals. Either if the C corporation is controlled by Canada, then the FAPI rule would apply. So even though in this case we have a corporation, we are still not achieving the tax deferrals. The next point is the dividend tax in Canada could be up to 54%. So some of you may know that for a taxpayer to receive a dividend from a Canadian corporation, they are qualified for preferential tax rate, depending on whether the dividend is eligible or ineligible dividend. That's part of our tax integration system. So the government try to make sure that the taxpayer basically pay the same amount of total tax if they earn the income through either a corporation or directly as an individual. This integration rule or the preferential rate on the dividend doesn't apply when the dividend was paid from a foreign corporation. So any dividend paid out from the C corporation would be taxed at the regular tax rate up to 54% in BC. As you can see in some of the summary in next slides, that you could see that this would drive up the total tax rate by quite a lot. Next is just some of the additional disclosure requirements. I bring up some of them. Atif would talk about it in higher details. It's in the case that the C corporation is controlled by a Canadian, then there was all sort of reporting is required in regard to the control for an affiliate. If not, then there was still the disclosure if it's 10% or more owned by a Canadian. And the last point is because right now we are talking about a security in a U.S. corporation. The share of the C corporation will be subject to U.S. estate tax. So with all the alternatives that we have gone through, the most common ones we have gone through, there were a lot more other potential structure as well. Even within this 5, there was different way of structuring it. You could have another corporation on top of those entity, or you could set up either S corporation in the US or some sort of limited liability, limited partnership. Like there were a lot of different structure, but we find this 5 is probably the most common one that our taxpayer keep running into. And the next slide, we just prepare a nice tax summary on the scenario of $100 of capital gains being realized. So as you can see that we basically break it into 4 columns. We put the individual and limited partnership together because the Canadian limited partnership, all the income would be flow directly to the individual. It would be subject to the same taxation as if you hold it directly. So as you can see that for the individual and limited partnership, the taxpayer could have access to long-term capital gain. They pay 20% on $100. And then they also pay Canadian tax on the capital gain. They got a full credit for how much US tax they pay, resulting the net tax about $27, which is the highest marginal tax on capital gain in Canada. So if you sell a Canadian real property, you would expect to pay the same amount of tax, resulting in after-tax income of $73. Then we move on to a corporation that realizing the same amount of capital gain, they're going to pay some US tax, and also they have to pay Canadian tax. But however, you notice that the tax credit is not going to be fully offsetting the Canadian tax. So resulting a net tax that is higher than the individual tax rate. So integration here kind of doesn't work perfectly. So in the case, we could see a difference of about 7% of tax difference. That's still not too bad of a result. If you could achieve certain level of tax deferral, you could have some funds in a corporation that you want to use. However, let's move on to some of the US entity. The first one is just the US C corporation. then the US tax is way higher. And also the Canadian tax is also way higher. And then also because of the structure, the tax credit is also not too efficient on eliminating double taxations. Something to point out here is that both the US tax and Canadian tax, including both the corporate tax payable when the income was realized, and also the additional individual tax that have to be paid when the corporation pay out a dividend. So you can see that the overall tax rate is up to 63%, resulting in after-tax income of only $37. So that's still not the worst. Let's move on to the last alternative of a US limited liability company. So the US tax is low, it's only 20% because of the flow-through nature. But however, the Canadian tax is just way higher than any other alternative because any distribution from the LLC is considered as a dividend that tax at the regular rate. And for tax credit purpose, if the distribution happened at a different year, there would be no foreign tax credit available, resulting a total tax of 73%. So as you can see, when you're comparing to the first scenario and the last scenario, we are talking about a tax difference about $46. So almost half of the capital gain got wasted if the wrong structure was set up. One kind of caveat for this summary is we are only covering certain scenarios. So every scenario have different implications depending whether you control those corporation, whether there was a corporate entity being the holding company of those entities. So your actual tax result may be different, but this is just for demonstration purpose that you could see what is the most tax efficient structure while which one is the worst. So with that in mind, we're going to cover some of the smaller topics related to owning a US real estate. One of them we have mentioned about in the key tax factor is the US withholding tax. The withholding tax is applicable to ownership by any non-US person, charged under the Foreign Investment in Real Property Tax Act, commonly referred as FAPI. You could think about it as a non-US person, when they sell a US real property, the US IRS really try to make sure that that person is still paying the tax. So they impose the obligation when the transaction happens. Whoever the buyer of the property supposed to withhold tax from the proceed. So depending on the price of the property and whether the buyer is going to use the property as a principal residence, the withholding rate could be valid from 0%, 10%, or 15% on the proceed. One key thing to point out here is the withholding tax is applicable on the proceed. It doesn't matter whether you actually going to realizing a gain or even a loss in the transaction. The tax was imposed by the proceed. And most of commonly, the taxpayer would be subject to the higher of the tax rate, which is the 15%. So when we are talking about hundreds of thousands of transaction or even over $1 million of transaction, 15% is quite significant in terms of cash flow. There was some potential solution to it, is the taxpayer could apply for a withholding certificate before the closing to reduce the withholding tax to base on the actual gain on the property. However, the application process tedious, and you have to rely on the cooperation with the realtor and the lawyer to keep waiting for IRS to process the certificate. A lot of time, based on our experiences, they are running out of patience or they don't want to wait for it, then they just remit the tax even before the withholding certificate has been approved. So you have again end up getting into the consistent fight with IRS, try to get the money back. Then there was also similar withholding tax requirement for some states. Some common one would be California, Hawaii, that the state would impose withholding tax, try to protect their tax right on the real property as well. So in case a withholding tax apply for certain state, the same could be potentially applied for the withholding certificate and reduce the withholding tax. It just adds additional filing burdens to the taxpayer. And another thing to point out here is the withholding tax is just going to take out from the proceed, but the final tax payable still have to be calculated on a tax return. Because they are withholding so much to begin with, most taxpayer that has remitted a tax at the sales, they are going to expect a huge tax refund whenever they file the return and calculate the appropriate tax payable, and the difference just will be refunded back to them. So with the US withholding tax in mind, we're going to move on to some of the Canadian tax consideration. So Atif is going to help us walk through all this.
Thank you, Philip. So we've already touched upon some of the things that you're seeing on the screen. For example, foreign accrual property income. Be always aware of it. The proposed rules that came out in April 2022 have made this a little bit more drastic, can create drastic outcomes for you. I won't get into the details of that, but whenever you have property income in a foreign country, it will be taxed on accrual basis in Canada, thus foreign accrual property income. So you can claim foreign tax credits for it and all that sort of thing. You can, and the second point I want to emphasize is repatriation. When you're bringing the funds profit back into Canada, when you're bringing the money back, now it's very rare, but if you have more than 5 employees in the real estate business in the US, and if you meet certain other conditions, the income from your operation will go into exempt earnings, which will become part of the exempt surplus. What that means is that when you bring the money back into Canada from a US corporation, US LLC or USC corporation, when you bring the money back into Canada, you will include it on the Canadian corporation's tax return. And I should mention that the US corporation should be owned by Canadian corporation for this exempt surplus to work or exempt surplus to apply. So the dividend will be included on your Canadian tax return, but you will get a full deduction for it. However, there would be withholding taxes, I believe 5% or so. So that could basically alleviate your taxes a little bit until you keep it in your Canadian corporation. The other thing to be mindful about is Canadian tax reporting. If you have more than 10% ownership in a US corporation, whether individually or through a Canadian corporation, you have to file a T1134 form. It used to be 4 or 5 pages form, but recently the CRA has made it almost double its size. There are a lot of things they want to be reported in it. So you should be always watching out that you don't miss out on the T1134 form filing, because the penalty could be $2,500 per day for 100 days to the maximum of $2,500 for one form. So if you have 5 US corporations, that would be $2,500 times 5, $12,500. And if you are not filing, if you don't have a foreign affiliate, but if your investments in the US or any other country, but US in this case, is more than $100,000, that could be in the shares of a corporation, that could be in your bank account in the US. Then if it exceeds $100,000, you have to file the form T1135. So be always aware of it. They often get missed, and that can result into penalties. And again, for T1135, similar penalty structure, $25 per day for $100, totaling $2,500. So on that note, I pass it back to Philip.
So our last topic today is U.S. estate tax. We have been mentioned about the U.S. estate tax on all the previous slides. So here is just a little bit more detail about when it's applicable, is any practical matter that we have to pay attention to. So for all the points here is mostly addressed towards a non-US citizen or non-US domicile. So it would be applicable to most of our audience that are Canadian citizen that doesn't have any status in the US. US estate tax would be applicable on a wider range of asset than most people that have expected. They would be applicable to US situs asset. US situs asset commonly including that real property located in the US, personal property or tangible property located in the US. The key thing here is the US security. So nowadays, most investors, they do have some sort of US stock. Those would be counted towards the US situs assets before you probably even know it. The exemption, there was no such exemption even in RSP. So anything that is US is issued by US corporation have to be included as a US situs asset. So it does provide some sort of exemption for a US non-resident, but the exemption is rather low. It's only $60,000. So as you can imagine, if you want to buy any US real estate, you're not going to get a lot of property for $60,000. So more likely than not, if you're invested in some sort of US property, US stocks, you would likely be exposed to US estate tax. However, the Canada-US tax treaty does provide some relief for Canadian residents that allows Canadian residents to claim a lifetime exemption equal to the one available to a US citizen. So how it works is a Canadian resident could claim the exemption. They prorate the exemption based on the US situs asset over the worldwide estate. So as long as your worldwide estate is lower than the lifetime exemption, for the Canadian deceased is only a reporting requirement. There would be not subject to any estate tax in the US. Currently, the exemption is $12.02 million, which is adjusted for inflation on an annual basis. And this exemption is supposed to be sunset in 2026, that reduced back to the 50% of the current amount. And also, for those ones that have paid attention, that the administration office from the president have paid a lot of attention to the exemption about potentially lowering it even further to try to capture a lot of estate tax on the wealthy family that is passing away. Let's say that if your worldwide estate is higher than the lifetime exemption limit, any excess portion will be subject to 40% tax rate on the fair market value. So that's the difference between US estate tax and Canadian death tax. Canada only imposed tax on any unrealized capital gain. Versus the US, they would take 40% of the fair market value. So it could be quite significant if you have a worldwide estate of maybe $13 million, then you have to still pay $400,000 on that 1 million that go over the limit. And this is the US estate tax is a liability personally for the executor. So the executor of any estate, they should make sure that the estate have to file or compile with all the US estate tax requirement. Otherwise, when the IRS comes back, they would be personally liable. So hopefully the estate still have enough asset within the state to remain there to pay all the estate tax. Otherwise, the executor will be liable for those tax. So with that, we basically wrap up our discussion today. Please feel free to let us know if you have any questions. And then after the webinar today, we will send up a short survey. We are going to want to hear from you on how we can improve and then the topics you would like us to cover. And from now on, we will stay for questions. And one of the general comment about this webinar is we are really trying to look at it from a tax 101 basis. There are a lot more details that we haven't get into yet, because those details could probably worth another 3 days of discussion. So there was no one clear-cut alternative that would fit all scenarios. Every taxpayer have their own factor to be considered for the best recommendations. So can one of our panelists maybe get us some of the questions from our audience and then ask either me or Atif, so we are trying to answer it here.
Yes, Philip and Atif, we have received a few questions today and also a few questions in advance of the webinar. So we will try to address some of the questions received today for you, Philip and Atif. So the first one, actually two, is that how does holding a U.S. property in a trust compare to the options discussed? And in relation to that, the other question is, I have an ownership of a U.S. property in a Canadian trust and also other properties owned in a Canadian real estate corporation, which operates in active business. So please share how holding a U.S. property in a trust would compare to other options.
So Atif, I could probably take a shot at this. So depending on how the property was used, it's mostly personal use or it's for business use. Typically, a trust is not supposed to carry on a business. They are not supposed to be assist for holding active business income. A trust really just holding assets for the benefit of the beneficiary. In case that the property was rented out and active rental income, a trust have the kind of the characteristic of they have the option of either retaining the income inside of the trust and pay tax on it, or allocating the income to the beneficiary. So the trustee would typically allocate the income to the trustee, which could potentially subject to a lower rate comparing to a trust. So whenever there was the U.S. real property, the income got allocated to the individual beneficiary, then the beneficiary would have to file a U.S. return and reporting such incomes. The trust also have to file its own U.S. tax return to report the income. Sorry, actually the trust filed the U.S. tax return and then calculated the net income and then allocated to the individual, and then the individual would pay tax on it. That's typically the implication for holding a real property inside of the trust. And I would let Atif to discuss about the implication of holding a U.S. real property in a Canadian corporation.
So, Efron, sorry, can you repeat the question with respect to the Canadian corporation?
Yes, so I own a U.S. real property in a Canadian trust. And I also own other properties in a Canadian real estate corporation, which operates in an active business income. So could you share what is the implication of this compared to other options?
So I'll make some assumptions here that the individual owns the Canadian corporation and the Canadian corporation owns a U.S. corporation, which is carrying out active business income. And if that is the case, as I mentioned earlier in the presentation, if the U.S. operations has more than 5 employees and it meets a couple of other conditions, then when the dividend is paid from the U.S. corporation to Canada, that dividend can be characterized as exempt surplus dividend. And what that means is that it will be subjected to the U.S. withholding tax, but when it is included in the Canadian corporation's tax return, it will get a full deduction for that dividend. So essentially, the only tax cost would be the withholding tax cost after the U.S. taxes have been paid.
Right. So we have another question here. If the only way I can invest in U.S. property is through a U.S. LLC as a minority owner or member, what structure should I use being a Canadian resident?
So I could probably take a shot at that. I think for a good reminder for that structure, it would be good to show the tax implications. This particular implication would apply to that scenario that the Canadian investor owning a minority interest in the LLC. So for every $100 of income or capital gain, you are expected to pay somewhat between $53 or $58 to $73 of tax. So you have to decide whether it's worth it for the investment or not when over half of the income is going to tax authority.
Right.
And also because of a minority interest, I don't know how much influence you have regarding the management. One of our partners always recommended that, hey, you should really, if the investment is significant enough, you should really talk to the manager saying that, how about changing the LLC into a limited partnership? And then you are even willing to cover all the additional compliance costs. Because when you look at the tax difference for every $100, you are saving $46. So if the income is significant enough, it's worth a shot. If not, then likely you would probably look for other better alternative for
Right.
investment.
Yeah, just to add there, Philip, and jump in if you want to. So for the capital gain tax, let's put that aside. There will be always discrepancies between the Canadian tax rules with respect to capital gains inclusion timing and the US tax rules. But in terms of the income when it is distributed, again, as Philip said, you are a minority shareholder, so I don't know how that works. But if the distributions are happening in the same year and as the income is being earned, then maybe you can get a better result. But again, being a minority shareholder, I don't know how you can do that.
Yeah, Atif comments is right. So let's say that using this example, if all the $100 of income was distributed in the same year when it's earned, you would get some foreign tax credit in Canada, reducing the Canadian tax rate. There was a constant fight on whether there was a limitation on the foreign tax credit you could get. You could either claim a 15% or potentially 20%. The end result it would be you're still going to pay about at least 53% of tax, assuming that everything got distributed out currently. So that would be the best result. The worst would be, as outlined on the slide, that you could potentially pay up to 73%.
Right. So we have the next question with regards to FAPI, FAPI, or Foreign Accrual Property Income. So under the FAPI rules and risk of double taxation explained earlier, could you briefly explain what is a foreign affiliate and describe how ownership of a foreign affiliate works?
Thank you, Efrain. So foreign affiliate is, first of all, if you have if you own the shares of a corporation outside Canada, then that's one condition that needs to be met. So foreign affiliate should be a corporation. Now, if you have a partnership in US, but it has any part of the world, but it has the characteristics of a corporation, there is a risk that the CRA might say that that partnership is a foreign affiliate. So first condition, it has to be a corporation. Secondly, you should own directly at least 1% share in that corporation, and the related parties should own at least 9% plus one share. So if you own, or 9% share, if you own 10% shares, you and the related parties, and in a foreign corporation, then that could be a foreign affiliate. Now, if you own more than one more share than 50%, that could be controlled foreign affiliate. T1134 form needs to be filed for in both cases, whether it's a foreign affiliate or controlled foreign affiliate. But the FAPI applies, the foreign accrual property income applies only when the corporation, your foreign affiliate that earns passive income, is controlled foreign affiliate.
Right. And in relation to FAPI, Atif, I'll just share the question here. For a capital gain earned via the US corporation, would the Canadian individual pick up that amount as FAPI income in the year of sale?
So is that capital gain being made being reported in the US corporation?
Yes.
Okay.
Via US Corp.
Okay, so let's say you control that US corporation. The rules can get pretty complicated, but generally, yes, the income should be reported on your capital, on your personal tax return, and you can get foreign tax credit for it. And now what has happened is that you have paid tax on income that is still sitting in the US. So the way rules are built, and without going into too much details, when the dividend is paid out to the individual, then certain adjustments and deductions are available that allows you to pay as much tax as you should have paid. There is no double taxation when the income is paid out.
Okay. I think we have other questions that we may not have chance to answer live, but we will definitely reach out to them after the webinar to address those.
Yeah, so thank you everyone for attending our webinar today. We would have more webinar to come, and also just another reminder about completing the survey. Let us know how we can improve and other topic that you might be interested in. And then hope everyone have a good day.
Yep. Thank you, everyone.
Thank you.